Welcome back, everybody. The coronavirus is impacting practically every part of the economy, and COVID-19 related claims are expected to hit insurance company books, putting them in a tough position. We're joined right now by Dan Amos. He is the chairman and CEO of Aflac. And Dan, it's good to see you. It's been a while since we've talked, and I know these are difficult times, but we're happy to have you here today.
Well, thank you, Becky. It's my pleasure to be here again.
Let's talk a little bit about what the impact of these coronavirus claims are going to be for you. What's the best that you can estimate at this point?
Well, I think when you look at the claims, you got to break it down when you hear the industry into whether or not it's the property casualty business or, in our particular case, health insurance industry. As you know, people aren't driving, so you're seeing property casualty actually refund money. In the case of health insurance, you're seeing a rise in the number of cases because of the pandemic, and you're going to see the cost rise. Saying that, though, actuaries are responsible for taking into account cataclysmic events that will take place. And we, as an insurance company, are in the business of being there in people's time of need. So we are ready to pay the claims and feel we're in good shape.
Were your rates already kind of factoring in the potential for a pandemic, or will you have to raise rates as a result of what most people didn't see coming?
No, we don't see that we'll have to raise rates. Now, remember, we don't, like life insurance, don't have cash values in the products where we have to worry about it. We've got to monitor it both in our Japanese operation and our U.S. operation. But we think our rates can certainly handle it without any rate increases at this particular time. But we've got to monitor everything. But we feel very good. We do stress tests. It was interesting on our first quarter call. We had a great quarter. We beat the street by 10 cents, but no one cared. What they wanted to talk about was a stress test and how strong our company was and whether or not we could handle financial impact of the coronavirus.
Well, I was going to ask you about that. I know you raised money, I think something like $540 million in yen-denominated debt in March, and that was followed up by U.S.-denominated debt of $1 billion. That's what good companies and conservative companies are doing right now, is raising money in the markets. Are you going to need to go back to the markets, or do you feel like that's sufficient to get you through?
No, our chief financial officer, Max Broden, did an interview the other day and said that we were set and that we should not need to have to go back to the market. I think the other interesting thing that can be said is that we did it at a lower interest rate. So we were ready for that. You know, when the financial crisis hit in 2008, we saw all insurance stocks drop dramatically. We said next time we will be better prepared. We'll have a broader base. We've done that. We've had higher liquidity. One thing I'll tell you is people are always interested in the dividend. We see our dividend remaining. And then finally, the share repurchase. We have cut our share repurchase in half. That's to send a message that we still think we're strong, stock values there, and so we want to continue to buy. But we're being somewhat cautious from a liquidity standpoint, and so we feel very good about it.
Hey, Dan, I know you took cues from what happened last time to make sure you prepared for it this time, and that's laudable. But this time never looks like last time. And I guess one of the big differences for insurance companies in particular is that this time you are looking at negative interest rates through much of the globe. And that's a big problem for insurance companies because you take that float, you put it into things that you can make money on now. But if you're dealing with negative interest rates, float almost becomes a liability. If you have to pay somebody to hold that money for you, what are you doing in terms of how you invest your money and making sure that you're getting some return?
Well, you're absolutely right about that, Becky. But we've been in a terrible interest rate environment in Japan, which is where 75% of our earnings come from, for quite a while now. And we've been able to work through that. In fact, the first quarter, we had a 4% return or yield on our money, which was fabulous for us. That isn't to say that we're not worried about it. We are. But we don't have a situation like most insurance companies do, where they have cash value and they have to constantly reinvest it. Ours is predominantly actuarially based on morbidity tables, and so we're pretty well situated in a good position. But believe me, if interest rates stay down for a long time, then something has to be done. Now, whether or not you'll have to have a rate increase on policies, that's what we did in Japan, as we've seen lower interest rates, not on existing policies, but on new policies to offset some of that. So we'll just have to wait and see what takes place. But certainly, it's an area we're watching carefully.